Smart24, where we drive your business. My name is Anthony, and you're still watching Financial Markets, where we give you a little more information concerning the banking sector, the financial services sector, and the capital markets as well, as they are faring here in Uganda, in the region, and of course, and the global scene as well. Now we are into our top stories, and of course, we begin, of course, with the commercial banks that have registered very high profit this year. Now, according to the Bank of Uganda, commercial banks' profitability has surpassed the 1 trillion mark. According to Bank of Uganda, the profitability increased by about 26.9% to about 1.07 trillion Ugandan shillings from about 846.2 billion the year before. However, a number of risks, including a surge in commodity prices, continue to present challenges to the banking sector as well. Commercial banking was slightly above 1 trillion mark during the period ended 2021, according to the Bank of Uganda annual supervision report. Now, the report, which highlights the performance of the banking sector in a number of aspects, noted that despite difficult economic times occasioned by COVID-19, the banking sector remained resilient during the period ended December 2021, supported by gradual recovery of the economy. The resilience, the report further noted, was also a result of strong capital and liquidity buffers supported by effective policy measures implemented by Bank of Uganda. Dr. Michael Atindi Ego, who is the Bank of Uganda Deputy Governor, indicated that the commercial bank's profitability had during the period increased by 26.9% to about 1.073 trillion from 846.2 billion Ugandan shillings, while the ratio of the non-performing loans was largely unchanged between 2020 and 2021 at 5.27% and 5.26% respectively. The growth was largely driven by an increase of 24.4% and 7.9% in the interest income from government securities and loans respectively. Overall, Dr. Atinji Ego noted that despite the existing risks resulting from commodity price shocks, financial stability remains elevated and resilient to potential shocks, given strong enhanced loss absorbency capacity reflected in existing liquidity and capital buffers. The report also noted that the losses among credit institutions decreased to 4.3 billion from 14.7 billion, while those attributed to microfinance deposit-taking institutions reduced slightly, falling to 33.9 billion from 36.8 billion over the period. However, the report noted that the main risk to supervised institutions, financial institutions' profitability remains the potential increase in the non-performing loans, which will result into growth in provisions for the loans that may become permanently impaired. Total customer deposits, which remain the main source of stable funding for commercial banks and constitute about 84% of the total liabilities, grew by about 6.8% from 26.8 trillion to 28.6 trillion. However, the report noted a slight drop in the proportion of foreign currency dominated deposits, which in the last 3 years have dropped from 37.2% in 2019 to 35.2% this year. Customer deposits for micro-depositing taking institutions increased from 355.9 billion to 383.2 billion, while deposits for credit institutions reduced from 593.7 billion to 226.3 billion, largely due to the upgrade of Post Bank into a commercial bank status. Bank of Uganda also noted that supervised financial institutions during the period continued to hold strong liquidity buffers supported by growth in deposits and holdings of government securities. For instance, commercial banks aggregate liquidity coverage ratio, which measures the ability of a financial institution to withstand a 30-day liquidity stress, increased from 229.6% to 251.2%, underlining the sector's strong resilience. In terms of lending and credit, during the period, the lending and credit continued to recover, but remained moderate. Total loans advanced by supervised financial institutions grew by 6.3% to about 18.4 trillion, compared to 12.6% growth over the period. Commercial banks registered the strongest growth in credit, increasing by 8.8% to 17.7 trillion loans by micro deposit taking institutions, and of course increased by about 2.3%, while those by credit institutions contracted by 58.4% due to the upgrade of Post Bank into a commercial bank. Yes, that is a story right there about commercial banks increasing, of course, in profitability, despite the current tough and beleaguered economic times. Remember, recently in 2020, the Bank of Uganda halted the issuance of dividends by listed commercial banks in a bid for commercial banks to actually reserve capital and be able to have enough money to take them through, of course, the uncertain times of COVID-19, but also the projected, financial difficulties in terms of price shocks and, supply chain disruptions and so on. And this actually comes as probably as a result. This profitability we are seeing probably comes as a result of some of the measures taken by Bank of Uganda. Sometimes it has to be difficult for you to go through a very difficult time sometimes, and so that you preserve the future and make sure you don't go through harder times in the times to come. And I think this is exactly what Bank of Uganda has portrayed in this case. With this increase in profitability, we hope our financial institutions will also increase their investment portfolios, increase their assets, and compete with other foreign, banking institutions to see them grow. Notably, some of the fastest growing banks like Finance Trust Bank, Diamond Trust Bank, you look at Stanbic Bank itself, most of them have been, channeling into investment banking and helping their clients use that saving to invest, especially in government securities that have become a very popular trend these days. Of course, this comes at a very huge cost at the moment, as the country grapples with price commodity increases and all the other factors that are putting a lot of pressure on our economy. But this, regardless, report is a very good one, and we hope this growth in profitability will contribute to the growth in the clients' average earnings, as well as we look at our financial institutions as well develop. That was a story right there from the commercial banks. Moving on to another story concerning the budget, the national budget. According to the Minister of Finance, Mr. Kasaija, the debt distress will be avoided by borrowing. Such a sarcastic statement, but that is exactly what he said. Now, the Finance Minister, Matia Kasaija, said that government will reduce overborrowing to safeguard Uganda from falling into the debt distress. While delivering the budget speech in Kampala, that is this week, Mr. Kasaija said that during the 2022-2023 financial year, government will align borrowing to suitable financial options to minimize the costs and risks exposure in both short and long term. For instance, he said that government will ensure prudent loans acquisition to avoid debt accumulation in a short term and the timely disbursement of loan funds to promote long-term fiscal sustainability. Mr. Kasaija said as of December 2021, the stock of public debt had risen to 73.5 trillion Ugandan shillings. That's approximately 20.7 billion US dollars, of which 45.72 trillion, that is about 12.9 billion, was due to external debt. And about 27.7 trillion, that's 7.84 billion, was due to domestic debt, which represented a nominal debt to gross domestic product ratio of 49.7%. Now remember, the threshold is about 53.1% as set by Parliament. And the ratio this time, the debt to GDP ratio, reached about 49.7%. Not really scaring, of course, compared to our counterparts in Kenya, who are standing at 68.94%, with the 70.7 billion US dollar debt. And of course, in Tanzania, down there, where they're at about 35 billion US dollar debt, and their ratio is about 63%. And Rwanda, which is projected by the International Monetary Fund to reach about 80% of their GDP by the end of 2022. Compared to others, we may seem not to be doing very bad, but when it gets to practically speaking, we may have a little bit more debt to deal with in the next couple of years. Now, the rise in debt was mainly due to an increase in the COVID-19 related borrowing, external and domestic shocks, and the financing shortfalls in the domestic revenue. However, Mr. Kasaija said that government, as a measure to ensure long-term debt sustainability, will reduce the level of domestic borrowing over the next financial year by the medium term, that is at an average of about 2.2% of the gross domestic product, before reducing it further to 1.0% in the long term. Other measures, he indicated, will include aligning borrowing to suitable financial modalities, borrow largely on favorable terms, and borrowing for projects that enhance productivity of the economy. Government has, in the 2022-2023 budget, allocated 8 trillion Ugandan shillings for debt servicing and debt financing, while interest payment has been allocated 4.6 trillion. And of these, of course, we have external debt repayments that stand at about 2.4 trillion. Under the Charter of for fiscal responsibility for the period between 2022 and 2026, government will to reduce the public debt about 50% of the gross domestic product. While Uganda's public debt has rapidly increased in the past 5 years, government has over the years maintained it is still within sustainable levels. However, debt repayments continue to present challenges at a time when COVID-19 has constrained the tax revenues while creating additional expenditure pressures. Now, the public debt movement show that the COVID-19 related borrowing has, in the last 4 years, seen public debt rise from 35.3% of gross domestic product during 2018 and 19 financial year to 49.9% by the end of 2020-2021. The ratio is projected to slightly increase above 50% threshold by the end of 2021-2022 financial year, and will peak at about 53.1% in the 2022-2023 financial year, before gradually reducing to below 50 by the end of 2025-2026 financial year, according to experts right there. That is a report on our public debt, and of course, it's creating a lot of a lot of people are worried, though government, as always, has maintained its position that our debt is sustainable. But is our debt truly sustainable? we want to look at what experts had to say when it comes to debt analysis for this country, Uganda. Now, the 48.1 trillion budget, 2022, that was according to experts, is out of touch with the current realities. Speaking after Minister of Finance, Matia Kasaija, had just delivered their budget speech in Kampala, Mr. Muwanga Chivumbi, who is an economist and MP of Butambala County and Shadow Finance Minister, said that for governments to behave as if times are normal is extremely abnormal, noting that the budget demonstrates that government is no longer concerned about people's needs. A number of Ugandans have since November last year asked government to rein in on commodity and service prices, many of which have risen above Bank of Uganda's 5% inflation target. Mr. Mwanga said that the essence of annualizing the budget is to draw projections that deal with current and long-term challenges, adding that the most government projects have become so predictable, thus diminishing the need to read the budget every year. On this part, Mr. Stephen Kaboyo, a forex expert and managing director of Alpha Capital, said, under the prevailing circumstances, government must recognize that there is very limited headroom to act decisively at the pace required to move the economy forward. Thus, he challenged government to relook into its consumptive expenditure, which does not compare well with the capital investment. The ratio of 70 to 30 is not the most appropriate at this time of economic hardship. He said, noting that the key test Uganda face is adapting to the shocks, yet government has not put in place policies that improve resilience and capability to sustain economic growth. Professor Augustus Nwagaba, an economist, said government must widen the tax base, which currently relies on a limited number of people to generate revenue. And the tax regime is constrained by a very narrow tax base, with very few taxpayers to fund a lot of people. That is, of course, what experts had to say concerning the debt, which is looming in the minds of very many Ugandans, and that are trying to say, is this really a serviceable debt? Is this something we can deal with? Is this something we can handle as a country? 73.5 billion with a budget of 48.1 trillion, and some of this budget, of course, going into servicing the debts that we have done in the past, with their interests accruing every now and then. Of course, that's a question government has to answer, but across the board, even in Kenya, many countries in Africa and in East Africa in particular are struggling with the debt crisis. And the debt distress, of course, is a very bad thing for the economy. As a matter of fact, in many countries that were declared in a debt distress are facing very much tougher economic times. Looking at Kenya's situation right now, with a 70.7 billion US dollar debt and 68.6% debt to GDP ratio, it's much closer to debt distress than we are, but they are taking a little bit of measures into this by, first of all, getting more concessional loans, and they currently withdrew their proposed 1 billion US dollar Eurobond. Eurobonds, as explained, of course, by experts, are just bonds that are issued by European, for example, banks, and they're given in euros. But they're debts, they're loans, they're not as friendly. And of course, these are long terms usually, and the government's usually pay in the long run. But still, this comes at a time when Kenya is also grappling with paying back its debt, which is quite big, with the 70.7 billion US dollar mark. And some of the ways governments try to regulate this is issuing treasury bonds to its local investors to help the locals actually help the government, but also government give back to their communities, give back to their countries and nations, rather than exporting most of this income to other countries in other in the foreign countries in the Western world. And these securities usually come at an interest rate or a coupon rate, which can be taken advantage of by you and me, so we can lend the government and be sure that it will pay us back, but not when it is at a loan or debt distress. When it's at a debt distress, it means it's risky to borrow to lend money to such a government because such a government failed on paying so many other loans, and there is no assurance or reassurance to customers or to investors that the government will actually not default on what it has said. Of course, there are very, very few instances where governments have defaulted before and failed to pay back these loans to the investors. But of course, these usually are not something we see in the world. However, right now it's very critical that governments come up with measures to see that they don't get into debt distress and remain sustainable. Currently, we will look at the government's situation as far as treasury bonds and bills is concerned. This is concerning the budget of the financial year 2022-2023, as we look into what has government put aside as money that is going to borrow from the public in the next financial year. So this money comes, as I said, in terms of treasury bonds, which are long-term. In Uganda, the treasury bonds can be actually 3 years or 5 years, 10 years, and 20 years, a maximum of 20 years. But you can have as well in Kenya bonds as far as 30 years. That's how big their scope of bonds is. And then the treasury bills, we can have treasury bills of 3 months, treasury bills of 6 months, and a maximum of 1 year. And they come at coupon rates that range from 10%, usually 15%, and sometimes they go as high as 17% in a very good time. So these are opportunities for you and me to invest. Remember, to invest in some of these securities, you only need a mobile phone. According to Altex, you can just dial *292# and then access their menu. You access an SCD account and you start trading. And not only securities in Uganda, but securities across the region as East Africa. We're going to another short break. We'll return with more stories. Don't go anywhere. My name is Anthony. You're still watching Financial Markets.